was also a good year for tech stocks, but our next guest says, don't expect a repeat performance. Brian Marshall is a tech analyst with Gleacher Co, and according to Bloomberg data, he's often right on the money when it comes to his calls on the industry. Brian joins us now from San Francisco. Brian, let's start with why is 2011 going to be disappointing when you compare it to 2010?
Well, I actually think it will be a solid year from a tech spending environment standpoint, but I don't think it will be as positive as 2010. If you look back, fundamentally things started to improve in about June of 2009. So we're about 18 months into a recovery cycle. And historically, those recovery cycles in technology have been about 3 years from trough to peak. And so, while we get into year 2 of a 3-year recovery cycle, I think things will start to slow down a little bit. So while I'm still optimistic with 2011, I think it will be a little bit less positive than we saw in 2010. So
we lose some of the momentum in the second half of the recovery cycle, and we're working off a higher baseline?
I believe so. I mean, architecturally speaking, we are going through a pretty tremendous shift from an enterprise infrastructure standpoint with regards to data centers. And so I do think that these trends will probably last for the next decade, but it will be, tech industry is cyclical, so it will not be without bumps. And, we haven't had a bump for quite some time. So, we will inevitably see that in the future.
This year, we heard a lot from the companies about how much cash they have, and we heard a lot of people urging them to use some of that cash to buy other companies, to make better investments, to pay back shareholders through dividends, through buybacks. Are we going to see some of these big companies deploy some of that cash?
Yeah, I think so. Yeah, I mean, clearly, investors want optimal use of balance sheets and optimal cash structures. And so, I think we'll see continued share repurchases. I think we'll see continued dividends for some of the bigger guys with slower growth profiles. And I think, from an M&A standpoint, we'll continue to see strategic M&A get done. That basically is accretive within 12 months is kind of the criteria for most tech companies out there. So I do think we'll see a continued use of cash, and perhaps that could accelerate it in the future.
Who's going to be the hot targets this year? Is it going to be more cloud computing and data storage type of companies?
Well, I actually think the puck, the puck went to that space this year. Where the puck gets passed next year, if you look at it from a sports analogy, I think 3 main areas will continue to do well. Number 1 would be managed services, so hosting applications under a cloud environment with stringent SLA, service level agreements. Number 2 would be continued adoption of solid-state memory or NAND flash memory in the enterprise, not only from an enterprise storage standpoint, but also from a server perspective. And then finally, number 3, I would say continued penetration of virtualization. At the end of the day, it's all about virtualization, and that's what's enabling cost savings. That's catalyzing this architectural shift in data centers. And so those are the 3 main areas that I'd be focused on.
Okay, and one of the big hot stories of 2010 was Apple, and this morning you reiterated your buy rating on the stock with a $355 price target. What could trip up Apple and Steve Jobs next year?
Well, I think if they don't bring a CDMA iPhone to the marketplace in Q1, that would be a negative.
You mean a Verizon iPhone?
Verizon, perhaps KDDI in Japan, some carriers in South Korea, and perhaps China Telecom. There's obviously a lot of CDMA vendors or carriers out there globally. Verizon obviously has 90 million subs, so they're the biggest one in terms of the opportunity. But it's a global opportunity as well. So I think if that does not happen, or if earnings fall shy of expectations, neither of which I think either will happen. It should be smooth sailing on Apple to $355, in my opinion.
Okay, very quickly here, Brian. Facebook, LinkedIn, Twitter, are we going to see them IPO?
There's a lot of demand for it, so wouldn't be surprised to see one of those guys go out in the second half of next year.
All right. Thanks so much. Brian Marshall joining us from San Francisco. He's an analyst with Gleacher Co.